All right, good afternoon and welcome to Market Domination. I'm Myles Udland, live from our New York City headquarters. Newly installed Fed Governor Stephen Miran is outlining reasons why he thinks interest rates remain too high, and Nvidia says it plans to invest up to $100 billion in OpenAI to build out data centers. There's just under an hour to go until the closing bell. Stocks higher across the board to begin this week. Yahoo Finance's Jared Blickery is standing by with a closer look at today's market action. Jared.
Thank you, Myles. We've got a green board here, and we're going to get the Wi-Fi Interactive up. This is what Nvidia has been doing. Well, actually, the NASDAQ has been doing year to date. Let's take a look at what's happening today. You're going to see a lot of red on here, but what counts is what we're seeing in Nvidia right there. That's up almost 4%. So is Apple, and you were just talking about that deal worth $100 billion in Nvidia allocated to OpenAI, and they're going to be doing power centers that are worth 10 gigawatts of electricity. I don't even have the capability of fathoming what that means, but here's the sector action, and it's no surprise that tech and utilities, talk about power, are the number 1 and 2 sectors here. Tech is up about 1.5%, and XLU is up just over 1%. Only a few things in the red here: staples, communication services, financials, and consumer discretionary. But let's take a look at the major indices. We have seen record closes for a number of these over the last few days. I was gone 2 days. Russell 2000 climbs to a record high. Then you got the SOX, the chip index, at a record high. Today we got the Dow hitting a record intraday high. So did the NASDAQ Composite, which is up 0.7%. The leader here, S&P 500, almost up 0.5%. That's a record high for that. Not for the Russell 2000, but it's still up 0.4%. And let's check out the bond market, because there's not a lot going down today, and that includes the 10-year T-note yield. That is up 1 basis point to 4.15%, and the 30-year is up a basis point to 4.76%. Meanwhile, the US dollar index is down just a little bit. Let's go back to our heat maps and track some of the leaders. Already went through the sector action. So here we go. Here are my leaders. Haven't seen biotech. XBI is a biotech ETF. That is in the pole position here, up 2%. I mentioned SOX before. That is a Philly chip index. We'll take a look at Nvidia and its cohorts in a second. Then we got Korean stocks, EWY. That is a proxy for chip stocks. Then we got gambling and bets. TAN is solar, biotech again, MAG 7. So the list goes on. What's not working today? We have crypto, that is down about 2%, as well as regional banks and home builders. But let's flip over and dig into semiconductors. We see a pretty green board here, not Broadcom, not Intel, but the Nvidia news has catapulted a lot of these issues higher in sympathy. You can see Taiwan Semi also up about 3.7%, Lam Research over 4%, and shifting over to software, which has lagged sometimes. Let me put this on an equal weighted basis, because Microsoft there, that big red square might mislead you, a lot more green than red, and that is led by Path up 10% and Playtika up 7%. I will briefly show you what's going on in China, because here's a red board, not BABA, not NetEase, but for the most part, a lot of these issues in the red. And also I mentioned crypto not having the best day, and also along with the fringe trade, we're seeing meme stocks really not in the green too much today, although I will say the poster child GameStop is up 2.6%. Myles.
You know, Jared, we're going to talk about small caps later on in the program. The rotation trade, though, it seems to be into software out of crypto, but we'll double click on that after the closing bell. All right, well, a busy week of Fed speak kicked off on Monday with new Fed Governor Stephen Miran speaking at the Economic Club of New York. Yahoo Finance's Fed correspondent Jennifer Schonberger has the details. Jen.
Hey there, Myles. In his first speech as Fed governor, Stephen Miran says he wants to see interest rates roughly 2 percentage points lower than the current level of 4 to 4.25%, arguing that the current level is just too high and risks higher unemployment.
The upshot is that monetary policy is well into restrictive territory. Leaving short-term interest rates roughly 2 percentage points too tight risks unnecessary layoffs and higher unemployment.
Miran says he wants to move more quickly to neutral on the Fed funds rate. That's a level that neither spurs nor slows economic growth, because he's concerned about the direction of the job market, but says he's not panicked. Miran voted for the first time in an FOMC meeting last week, dissenting because he preferred to cut rates by 50 basis points instead of the 25 basis points that his colleagues voted for. And previewing what he might do at the October policy meeting, Miran said he would again vote for a 50 basis point rate cut, but that any changes would hinge on any change in his economic view.
I arrive at a view, and then I will sort of continue, until my view changes, I will continue arguing for that view. I'm not going to vote for something I don't believe in just for the sake of creating an illusion of consensus where there is none.
Miran says changes to U.S. border policy, which have led to lower immigration rates, along with new fiscal policies, are not being accounted for current interest rate levels. He said he thinks the Fed's policy rate is actually more restrictive than others believe. And while some still worry about the impact of tariffs on inflation, Miran said today that relatively small changes in some goods prices have led to what he views as, quote, unreasonable levels of concern. Now, Miran is on a leave of absence from his White House position as the president's chair of Economic Council of Advisors. When asked if he were to speak with President Trump as a Fed governor, if the president were to assert that he wanted a specific decision by the central bank, Miran said he would weigh the president's views and its merits, but ultimately would make his own decision independently. Myles?
Now, Jen, we talked on Friday about how busy it was for Fed officials this week, and Miran was not the only Fed official speaking on Monday.
That's right. We heard from two other members of the Fed today. Earlier this morning, St. Louis Fed President Alberto Musalem said he supported cutting rates last week as what he called a precautionary move to guard against higher unemployment. But he also cautioned that there is limited room for further rate cuts before risking a boost in inflation. And speaking of inflation risk, we also heard from Cleveland Fed President Beth Hammack, who is more concerned still about the inflation side of the Fed's mandate rather than the job side. She said this afternoon that the Fed should be, quote, very cautious in removing monetary policy restriction, citing upside risks to inflation.
All right, Jen Schomburger with the latest on all things going on with the Federal Reserve. All right, joining us now to continue our Fed conversation is Thomas Hoenig, Distinguished Senior Fellow at the Mercatus Center and the former president of the Kansas City Fed. Thomas, thanks so much for stopping by today. I'd like to begin with the comments we heard from Governor Miran, his dissent last week. You, as a member of the FOMC, know something about dissenting during pivotal moments in monetary policy history, pivotal moments of regime change. I'm curious what you make of his insertion onto the FOMC at this moment in time when the Fed is beginning its rate cutting cycle, and there's so much discussion about the magnitude, the destination, and what this really means for the end of what appears to be the Powell Fed here.
Well, it's an interesting time, I would have to say, and thank you for having me on here. But let me first start with, I think Miran is certainly entitled to his view. I think it's good that he is expressing it. That adds to the debate in the meeting, and I think helps clarify points on both sides, those who are in favor of further cuts and those who are opposed to it. I think his focus on the neutral rate, the real neutral rate, is, I read his speech, it's fairly complicated in the sense of putting a lot of weight on the immigration issue, but there are other issues as well in terms of productivity, future, and so forth, which he, I think, over the next few days or weeks, will have to explain more, shall we say, more extensively if he is going to carry any weight in the next meeting.
I'm curious, just from your view, looking at the economy right now, and you've seen Chair Powell talk a bit more about the pressures that he sees rising on the employment side of the mandate, kind of what you make of this moment for the Fed where inflation has not returned to goal, but they seem to be comfortable with it, and they're trying to guard against building pressures that aren't yet seen. I'm just curious what you make of that today, and when you were in those meetings, how you thought about balancing, let's say, the risks you can see with the risks you think you're going to see.
Yeah, you have to be very careful with that. There's a lot of pressure on the Fed to ease rates now. There has been, and that can affect how you think about things, how you weigh different factors coming into it. And I'd say that they are being overly cautious in terms of their concerns for unemployment, which is 4.3% in most most of our history, that's been considered pretty close to full employment, and dismissing the fact that we have inflation that's 3%. And actually rising. And that's a major issue. And I think that's what the Cleveland Fed president was pointing out to people. So I think there's a broad mix of opinions now. And I do think, and I worry that they're more concerned with unemployment than inflation, which is surprising because in the long run, I would tell you that you can't have maximum employment without first having stable prices. And 3%, just to remind people, is 50% over their target and 300 basis points over what you would call stable prices. So they really are in a state of flux right now.
And I guess as you think about the tools that are available to the Fed, are those perhaps more more able in a quick and sudden manner to address problems that arise on either side of the mandate, meaning, an employment issue, should we see unemployment rise, that perhaps could be addressed by the Fed easier than inflation, where we've seen the central bank now struggle for several years to get back to that 2% level?
Well, it's more difficult than that because number one, you have to know what your premise is. The premise I've always followed is that you will not have long-term maximum employment unless you have a stable price environment. And right now, I think they should be focusing on price inflation, which is well over its target and well over stable prices. Because if they don't, in terms of easing, look at what's happening. We have a stock market that's booming. We have asset values again appreciating. These are the ingredients, if you will, of a bubble. And let me point out one other thing to you. As Miran talked, he was talking about the neutral rate, the real neutral rate being perhaps 1% or less, whereas most of the econometric economists right now are talking about the neutral rate being closer to 1.5%. And when you look at what real interest rates are, the policy rate that the Fed's following, it's 4% less than 3% inflation, it's 1%. That's not a restrictive policy. And that's what I think you have to remind the FOMC of as they begin to think about policy in the remainder of this year, when they're talking about one cut or two cuts or no cuts. And I think they are in a fairly accommodative position right now. And I think should be the point of focus.
I want to finish with the conversation about the Fed, the pressures that the central bank has been facing over the last several months. You were serving on the FOMC during a very charged moment, obviously, in American economic history, global economic history. You've seen the central bank take all kinds of blows over the years. I'm just curious, from your current vantage point, contacts you may have, former colleagues, just what you've made of the last few months, and are we seeing any of those external pressures, though Fed officials will say we block out the noise, beginning to weigh on the process based on how you see things from your current seat?
Well, I think the fact of the matter is that those kinds of pressures are always there, and you don't block them out. You deal with them. And that's what they're having to do right now. Those pressures only build because our national debt, even with the tariff taxes that have raising revenue, are still going to be close to $2 trillion. That has to be funded. That'll put pressure on the Fed to help fund that and help suppress interest rates so that it can be funded. So those pressures are only going to build. And while I think the Fed can resist those pressures, it would be to, I think, overstate it if you think they're blocking that out, because those pressures are there every day. And the consequences of saying no are in front of them every day. So it's not a simple matter by any means.
All right. Really appreciate the time. Thomas Hoenig,
Sure.
Former president of the Kansas City Fed. Thanks so much.
Thank you for having me.
All right, where Oracle is in the spotlight to begin the week. Stock here up about 5%. That's after the cloud giant looks on track to lead a consortium of investors that will control TikTok's U.S. assets. The company also announced on Monday a shakeup in its C-suite, naming co-CEOs to replace its longtime chief executive, Safra Catz, who will now serve as the company's executive vice chair. For more on all things Oracle, we're bringing in Alex Zukin, managing director and head of software research at Wolfe Research. So Alex, let's start with the changes that we saw today from Oracle in the C-suite, what you make of them, and how you see this as reflective of perhaps some of the news we heard from them earlier this month on what their order book says about really the future trajectory for the company's revenues.
Yeah, well, look, I'll say first, leadership changes are always a difficult scenario, and best to do the difficult thing when things are going excellent. I think that was kind of the place from which Oracle was thinking through this. That's what Safra said this morning on the call with analysts, and I completely understand and agree with her judgment. I think that Oracle is in the midst of a generational growth acceleration curve, underpinned by the rise of AI and their role and place in becoming one of the hyperscalers to service that demand curve. And so I think that as a result, elevating these two executives, Clay McGurk, who really is one of the architects and drivers behind the OCI story, the Gen 2 cloud, the Gen 2 infrastructure that they've been delivering. I think that makes a lot of sense. I would say we were a little surprised to see a co-CEO structure, but it makes sense. One of these executives is kind of more applications vertical centric and sales focused. The other one is kind of more core deep infrastructure, OCI, kind of Gen 2 cloud focused. And look, I think given we're going into a big analyst day in October where the company is going to share more information and details about the quality and quantity of its backlog and the contracts that are powering and funding really this growth acceleration story, the timing makes sense.
You know, as you began answering, I was like, you kind of jumped on the question I should have asked, which was how often do we see a stock go up 5% after the company comes out and announces an executive change, let alone one where there's a dual CEO structure. So just to double click on that piece of it, you talked a little bit to kind of your comfort with that two-part structure. But I mean, when they have that investor day, do you think they're going to be thinking about differently reporting areas of the business? Is this a company that could look to break itself into two different parts with this structure? How did you think through possible permutations of this new co-CEO structure they have?
Yeah, I would say it's very unusual. Co-CEO structures are rare in that they are mostly, they don't work as well as singular CEO structures. So I think that was one of the surprising dynamics. I think also this is a company that's effectively been led by really the same team for the last, call it 30 years, by and large. Yep. So these are very, unique events that happen very rarely in kind of separate from the dual CEO structure. At the Analyst Day, I expect us to kind of understand the dynamic by which they will lead. They clearly, the two execs are from slightly different parts of the organization. And so to the extent that there's a scarcity of dollars to invest, in funding the growth in infrastructure versus funding the growth in apps, it'll be interesting to see how they kind of tackle that distribution of resources. But at the same time, one of the elements of the Oracle story is this synergy and platform of being full stack. So having the infrastructure, having the apps, having the database, and being able to leverage kind of the promise of AI and inferencing against your enterprise data, similar to what a consumer does with ChatGPT, the ability for that action to drive cloud migrations and modernizations of a customer's application stack, of a customer's database stack, and ultimately creating a win-win-win situation, a win for customers in that they have modernized and put themselves to be ready for an AI first world, a win for Oracle, obviously, as they can extract a lot more value and unit economics out of the business, and a win for investors where that funds profitable growth, not just growth for the business.
And then just quickly, I want to get you out of here on the TikTok news. We've seen now, it's been several years, Oracle's been discussed as a potential data partner for TikTok's U.S. assets. How do you think about that, really, if at all, when you look at the model for Oracle, the story for Oracle, and one that, as we've discussed here, dramatically changed within the last month?
Look, I think it's clearly a positive for Oracle that they continue to be one of the de facto providers of infrastructure for one of the most viral and overall consumed workloads, globally. I think that's a positive. I think that you really should think about it also. They not just do they have TikTok, and now they're also aligned with ChatGPT and Meta and XAI and Nvidia, but they continue to emerge as a strategic provider of critical functionality for the most scaled workloads in the world. all of those things are really good for Oracle. They get to learn through powering those workloads what is necessary to deliver at scale, securely, across a very complex and evolving geopolitical landscape. So I think that those are all positives for investors, increasingly so in a kind of this unique world we're all going into.
That's right, tech and geopolitics, certainly in a new era. We'll leave the conversation there. Alex Zukin with Wolfe Research. Appreciate the time.
Thank you for having me.
All right, coming up, stocks rising ahead of the closing bell on Wall Street. We'll dig into your portfolio positioning ahead of year end. And President Trump is raising the price of an H-1B visa. We'll dig into what the program does and who it benefits. Plus, the GLP-1 race continues. We discuss the winners and the losers. Stay tuned. All right, stocks trading higher with less than an hour to go before the closing bell. Tech-heavy NASDAQ leading the way after Nvidia coming out and announcing that $100 billion investment into OpenAI. Markets also closely watching a slew of Fed speak this week. Here to break it all down is Brian Levitt. He is Invesco's global market strategist. Brian, good to talk to you again. Let's just start with kind of how you're thinking about stocks. Record highs. We got what we wanted from the Fed. We got through that event. Felt like a clearing event in some ways. What are you looking at as we head towards third quarter earnings season, towards the end of the year, and maybe an environment where people are making peace with stocks at record highs instead of being so upset about them?
Yeah, it has seemed like a battle for a lot of this year. I think it makes sense to continue to make peace with equities. The global backdrop's reasonable enough. Companies continue to grow earnings. If you look at corporate profitability divided by the number of employees companies have, it's absolutely surging. Inflation expectations are contained. The Fed wants to lower interest rates further. All of that is conducive for equities to continue to perform well between now and the end of the year.
Let's talk a little bit about valuations and sort of what your conversations are like there when you are out talking to clients. Are folks still bothered by where we see the S&P's multiple? Are they decomposing that between tech and other sectors? Like, how does that conversation go?
I think people are still bothered by it. And one of the things that people need to realize, if you think of three distinct phases of a business cycle, early phase, investors tend to miss it because things don't look great. Middle phase, things tend to be a bit more expensive and returns are good, but more muted. And then you obviously want to avoid the late stage. Valuations are not timing tools. You could have valuations excessive for a while, but you would probably need to see something break in the economy or the Federal Reserve have to raise interest rates, neither of which are happening right now. One of the things I try to explain to investors, and you are alluding to this point, is that the markets are heavily concentrated. If you look at market cap indices, and some of those valuations on the bigger names are driving extended valuations across the index. If you were to look at the same 500 companies equally weighted, the valuations are not as excessive. If you look at mid cap, small cap, Europe, the emerging markets valuations are not as excessive. So when you're talking about elevated valuations, it's largely a market capitalization weighted U.S. index that you're talking about.
Yeah, and you mentioned Europe. Let's talk a little bit about the international piece, specifically on stocks. What those conversations have been like. Are folks getting on board with the idea of that geographic diversification, where we've seen Europe outperform for a good chunk of this year after it felt like 10 years where you were getting nothing internationally and everyone hated that story. No one wanted anything to do with it. Feels like this has been a bit of a change in 2025.
It has, and maybe it's a little bit of a slow grind with investors that tend to have a home country bias. You talk about those 10 years. Those 10 years were characterized by a very strong dollar environment, whether it was the U.S. responding to crisis with greater fiscal stimulus or U.S. tech companies growing earnings far beyond that of many businesses around the world. You ended up with a very strong dollar environment. So what we're seeing now for the first time really in years is a gradual easing process by the Federal Reserve. 2020, we went to zero immediately. 2008, we went to zero immediately. So we haven't seen this in a while. What tends to happen in gradual easing environments is that the dollar can moderate over time. And as the dollar moderates, well, that incentivizes investors to look elsewhere to own assets in other currencies. That starts to unlock value outside. You add on top of that China looking to stimulate the economy, as well as the Europeans with increased infrastructure and defense spending, you end up in a better environment than we've had for global investments in quite some time.
All right, we'll leave it there. Brian Levitt with Invesco. Appreciate the time.
My pleasure. Thank you.
All right, time now for some of today's trending tickers. Yahoo Finance's Ali Canal stopping by the desk for a look. Let's start with our old friends over at Nvidia. That stock higher today after the news the company would invest $100 billion into OpenAI.
Oh,
is that it? Yeah, we're going to go with that.
I mean,
I got nothing else for you.
Well, I feel like this is a big deal, obviously, in the AI space in general, $100 billion.
Yep.
It does make me think about the fact that OpenAI is a privately held company, and if you have companies like Nvidia, the hyperscaler, just throwing money there, will it ever have to go public? And if it does, what would the reception be? But it is going to build out at least 10 gigawatts of new AI data center capacity. That's 5 times the size of Meta's Louisiana build out, and equivalent to as many as 5 million Nvidia GPUs. And it's really something that's benefiting both companies. For OpenAI, it's this lifeline as it scrambles to really secure capacity after signing some of those pricey deals with Oracle and CoreWeave. And then for Nvidia, it locks in a lot of this huge demand for its chips and reinforces its role as sort of the backbone of this AI economy. And I think it shows how early we are in the build out here when it comes to AI infrastructure.
You know, we're still at that point where as I'm reading this, I'm like 100 it's billion, right? 100 billion, not with a million. It feels like these numbers. I mean, look, it's just zeros on on a screen. It's fine, but there is something about Nvidia coming out and saying we're investing $100 billion in already the largest private company on record, and the market's like, great, stock's at a record high. That's great. We'll bid you up another 4% today.
Exactly. And we know how heavily weighted the stock market is to Nvidia. And if Nvidia rises, that usually works for the rest of the stock market. What do you mean, here we go? That's just a fact.
But
I didn't have a but. I mean, of course, you don't want to have too much optimism in the market. I don't think there is that much optimism in the market. I think you could look at our next trending ticker story and maybe talk a little bit more.
Let's talk about this.
A little deep tease, as you say.
Here's a detour from one of the biggest companies in the market to a company most of us hadn't heard of until today, and that is Better Home and Finance. That stock surging after hedge fund manager Eric Jackson, who was behind the call on Opendoor, came out and said this is the Shopify for mortgages. The stock had doubled earlier in the session. Now it is up about 60%.
Yeah, he says it could be a potential 350 bagger within 2 years.
I love the bagger term.
I know, I like that too.
If you say something's going to go up a lot, say bagger.
Yeah.
Don't say X, it's going to double, triple, say it's a bagger.
It sounds better to me.
For sure.
And, we were just talking about maybe a little over-optimism in the stock market. And when you look at companies like Better Home, Opendoor, a lot of these more meme-ish plays that have just seen this explosive growth, it does beg the question of whether or not markets are getting too frothy, whether there is too much speculation here. But Eric Jackson really doubling down on the fact that these are actual tangible business models. They are going to utilize AI. They are going to revolutionize the real estate market. But we do have a real estate market that's a bit tricky. It's been a little up and down, a little dormant. Mortgage rates seem to be coming down, but that hasn't necessarily translated 100% through into demand in the housing market. So it's just one of those situations that we're going to have to wait and see. But clearly, the reaction to this stock opened at 33, spiked above the 70s. Now we're trading closer to 55, just under $60. I mean, still a massive move off of one call.
Yeah, and let's talk about the name that we both mentioned, Opendoor, which is Eric Jackson's original call, sort of how he got himself, and I've known Eric for years, but how he got himself back into the mix this time around. That stock down almost 10%. Now, the stock had rallied on Friday, but we've seen moves up and down in Opendoor, and as you were saying, Ali, it does feel like Opendoor better, what are we going to call it? Like the EMJ trade? Like that's now the sentiment trade more broadly within the market. And you kind of see it here on our website. You kind of go on top trending ticker every day. Pretty much it's open door.
And we do have the Fed starting its easing cycle, cut 25 basis points. Again, that is a positive for the housing market in general, and we have seen that flow through into some of the sectors like home builders and financials, among others. And it just feels to me, though, that it's a meme play, right? I feel like if you want to have a little fun in the market, maybe you get in on Open Door and some of these more volatile names, but it's not necessarily going to give you the same, I guess, confirmation that maybe your Nvidia other AI plays, maybe purebred AI plays.
That's not what Eric says.
Well, and look, Eric called the Carvana bottom, right? I mean, people follow him. He has a really big following. They just had new leadership from Shopify move over to Open Door, and that caused the stock to run up. And when you have crazy moves to the upside, you're going to have moves to the downside too.
Yeah, the whole thing with the meme trade, we talked about this with Luke Howell on Friday, is the way it went from like just a total joke to now
you
it's
have to take it seriously or more seriously.
Well, but like the folks know the makings of here's how you create a meme story, and underneath there must be a fundamental case, and essentially digitization, modernization of the real estate market in the US. Great. Huge market. We've both bought property. Huge pain. So there you go. Buy the stock.
And it might cut out maybe the middleman, your
middleman, multiple.
Multiple.
There are men everywhere. You go to buy something, there's just people come out of the woodwork. They say, I need that.
Like AI is about productivity, making things better, and I do think the housing market, that process there is room for improvement there.
One-click buying next time.
Exactly.
We'll go with that. All right, Alec Canal, we'll leave it there. All right, well, the Trump administration looks set to revamp the H-1B visa program, raising the application fee to $100,000 and potentially upending one of the country's signature immigration policies. But what exactly is this program, and who does it serve? The H-1B visa allows U.S. employers to hire foreign professionals in so-called specialty occupations, jobs that require at least a bachelor's degree, often in fields like computer science, engineering, or medicine. The idea is to fill labor shortages in areas where U.S. workers may be scarce by bringing in other individuals with skills not otherwise available in the domestic workforce. Now, workers cannot get this visa on their own. A U.S. employer needs to petition on their behalf, registering electronically and paying the required fees. And until now, the process typically cost employers just a few $1,000s, but under the Trump administration's changes, the price tag for a new application is set to jump to $100,000. Once registered, applications go through a selection process run by U.S. Citizenship and Immigration Services, and not everyone who applies will be granted an H-1B visa. For the fiscal 2026 cycle, there were over 350,000 total registrations, but only 120,000 were selected. Coming up, Google is back in the legal spotlight as a new trial gets underway over the tech giant's digital advertising practices. We'll break it down next. All right, crypto and gold diverging to start the week. Yahoo Finance's Inez Ferre is here with a look at the latest action in the safe havens. Inez.
Yeah, Myles, and just taking a look at gold, you are seeing record highs with gold seeing 5 straight weeks of gains. And you're seeing these record highs with gold at 40%. Look, gold right now is 40% up for year to date. That is on pace for its best year since 1979, when gold was up around 130%. This has been a monstrous year for gold. Remember that the last time that we saw multiple record highs was back in April. Then you had a consolidation period. Now it's breakout once again. A lower dollar, that's been contributing to gold's rise, the Fed easing, central banks buying more, and you still have Wall Street bullish on gold. You're still looking at calls of 4,000 by mid-2026, some with bullish calls up to 5,000 by the end of next year. Goldman Sachs, though, did say that beware of speculative plays. You could see some pullbacks on the way higher. Taking taking a look at digital gold, if you look at Bitcoin today is down more than 2%, trading around 112,000. You're seeing ETH, Ethereum, though, that's down about 7%. Solana also down, taking quite a bit lower. There's no clear catalyst for why we're seeing crypto prices under pressure today. Part of what's been talked about is the sheer number of crypto treasury companies that have come online that are basically copying Michael Saylor's strategy on adding crypto to their balance sheets. But look, September tends to be a volatile month for crypto. For Bitcoin, it tends to be a seasonally weak month. Bitcoin is typically better in October. You still have bullish calls when it comes to Bitcoin and also ETH. You've still got some analysts that are calling for ETH to double by the end of the year, Myles.
All right, Inez Frey with the latest on what's happening with the safe havens. All right, well, Google headed to court on Monday to face its latest antitrust challenge, this time to its advertising business. Last month, the company received a favorable ruling from a U.S. District Court judge related to its search business, which was left virtually untouched. Joining us now to discuss the latest legal headache for the company is Bill Kovacic, former FTC chairman and a professor at George Washington Law School. So, Bill, let's just start with the challenge specifically that Google is dealing with in district court, its distinction from the ruling that we saw for the company late last month.
You mentioned, Myles, this case focuses on ad tech, on its advertising services, the ad exchange and the operation of the ad exchange. So this case seeks, in the Justice Department's view, to loosen Google's control over this critical element of the advertising stack and to give publishers and advertisers more freedom to choose alternative strategies for dealing with each other.
Now, I'm curious, in your view, based on the ruling that we got last month, how this maybe impacts the government's case going in, the government's thought around the case, Google's case going in. Like, is there a relationship here, in your view, of how the company and the government may approach these proceedings, given what we saw handed down in late August?
We can be sure that the judge in the ad tech case is going to has studied that earlier decision very carefully, both to look at the framework that Judge Mehta used in the search case and to assess how it might be applied in her own circumstances. So that's going to be a very informative framework. The key difference is that Judge Brinkema's case involving ad tech involved different facts, somewhat different arguments, and she has considerable discretion to decide how she will apply that legal framework. So the lighter touch treatment that Google received in the search case does not necessarily predetermine a similar outcome in the remedies case in ad tech.
Now, I'm curious, though, we've seen kind of let's say the environment towards antitrust, the enthusiasm that some corners of government have around enforcing certain statutes or, interpreting them certain ways has changed in the time since this case was first brought and then we actually go to trial. How does either side think about that in the run-up to a proceeding that is, this kind of high profile, especially around a company like this, with the potential, remedies that I think some thought could be handed down depending on which way the judge breaks?
One area of continuity that we've seen across the Biden and Trump administrations is a commitment to pursue these big tech cases. The leadership of the Department of Justice has been emphatic in saying that their approach is full speed ahead, that the broader aim of structural relief, which would involve some element of a divestiture, is still front and center in their remedial aims, so that the Trump administration and Biden administration, although they're not fond of saying they have much in common, seem to have common cause on this case.
Now, another element of change that we've seen, over the course of these proceedings, and something that was a big feature of Judge Mehta's ruling, was the way that AI had reshaped the search market in the interim period between when the lawsuit was filed and now. How did you think through those comments, and maybe does that, the way that AI has changed the entire digital landscape, might that feature in the discussion around what remediation Google may or may not face, regarding its ad business in this case?
Judge Mehta in the search case certainly emphasized AI as a consideration that cautioned against broad, deep structural intervention in Google's affairs. I think a major focus of this 2-week hearing that started today on remedies will involve Judge Brinkema pressing the parties very hard to address how AI affects the circumstances of the case that she heard. I think she's fully aware that this is a transformative technology. But at the same time, I think that she's going to want the parties to do more than simply, especially Google, to say this is an important factor. She's going to say, how does that factor specifically affect the remedial options before me? Explain to me how AI by itself or in combination with different remedial approaches will affect competition in this sector. So in many ways, she can go to school on this earlier proceeding in front of Judge Mehta to formulate very pointed and I think difficult questions about how AI actually affects competition in this sector going ahead.
All right, certainly a case investors will be closely watching. Bill Kovacic, thanks so much for the time.
Thank you, Myles.
All right, coming up, the race for dominance in the GLP-1 space. We'll compare the contenders. Coming up right after this. All right, breaking news here. Disney's ABC says that Jimmy Kimmel will return to the air on Tuesday. Yahoo Finance's Ali Canal joins me here with more.
Yeah, full circle moment here after the saga that we saw unfold over the past week. Jimmy Kimmel Live was abruptly suspended last week after FCC Chair Brendan Carr threatened ABC over Kimmel's remarks about the MAGA movement. And within hours, Nexstar, which is that ABC affiliate owner seeking FCC approval for that merger with Tenga, Nexstar said it would preempt the show, effectively forcing ABC to pull it. Now, there's been a lot of back and forth, a lot of discourse about the reason why Jimmy Kimmel was ultimately canceled. Was it this building political pressure? Was it the fact that late night shows in general have been struggling with some of their ratings? I do have a statement from Disney about bringing Jimmy Kimmel back. The company saying, quote, "Last Wednesday, we made the decision to suspend production on the show to avoid further inflaming a tense situation at an emotional moment for our country. It is a decision we made because we felt some of the comments were ill-timed and thus insensitive. We have spent the last days having thoughtful conversations with Jimmy, and after those conversations, we've reached a decision to return the show on Tuesday." And of course, the tense situation that they referenced was the assassination of Charlie Kirk, that more conservative voice. And it really is a very contentious time in our country, and we are seeing that ripple effect across multiple news organizations. Stephen Colbert's show will end after next season. There was some conversations even there with the merger between Paramount and Skydance, whether that had to do with any political headwinds or political motives. But CBS basically kind of saying that this was a show that was ABC. Struggling ratings-wise. And even Jimmy Kimmel, I mean, it hit 1.1 million viewers in August. It trailed the competition and really gave Nexstar and ABC more incentive, perhaps, to take a beat and figure out what to do next.
Yeah, and it's interesting. Certainly we're looking here, thinking about the implications for Disney stock, if there are, what that company is going to do, how it makes sense of its ABC asset, the ABC News asset that's attached to that. Yeah. But overall, I think, even the way that conversation was had last week, the assumption was, oh, well, Kimmel's done forever and this is how it ends. And so then to see ABC announce today that he'll be back tomorrow on Tuesday evening, I think a twist in the story that, as a casual observer, not someone who's deeply reporting in the space, but who is a media consumer, just like most of our audience, frankly, I'm surprised to see this decision.
And there was a lot of backlash after they decided to take Jimmy Kimmel Live off air, and we saw various talk show hosts sign a letter trying to get him back, and there was some reporting out there that surprised Disney executives how intense the backlash was. But you talk about Disney, the future of the company, it's definitely focused on streaming. Disney Plus, it merged the Disney Plus app with Hulu, ESPN, direct-to-consumer. That is their focus. Broadcast, linear television, it's just not the same as it was. And that means that late-night television, the format might have to change a bit because we have consistently seen those steady declines. But clearly these were conversations that Disney had been having with Jimmy Kimmel over the past week. They reached this mutual conclusion. And I mean, I'm sure the ratings on Tuesday, you're going to have a little bump there to see what that monologue is going to be like.
At a minimum, it seems like this is not the way that Kimmel's era at ABC will end. All right, Alec, now with the latest. Thanks so much. All right, switching gears now, we are navigating how to play the GLP-1 trade. Joining me now is Evan Siegerman, Managing Director for Biopharma Research at BMO Capital Markets. Evan, thanks so much for joining the program. Let's start with this morning's news. Pfizer buying Metsera. Where is Pfizer in the GLP-1 race? Because to me, as a casual observer of what's gone on, I think Novo, I think Lilly, I don't really think about anybody else. Where does this bring Pfizer, within that context?
Great question, and thank you for having me. So a little bit of history. Pfizer had been working on their own small molecule GLP-1 drugs. Both of those were discontinued. This would have been similar to Lilly's orforglipron. And I could tell in my interactions with the company over the past year or so that they've been itching to be in the obesity space. Actually, a couple of years ago, I'd done a presentation at Pfizer HQ outlining the space. I could tell some enthusiasm was there. So this brings them, really brings them meaningfully ahead. They're still behind Lilly and Novo. But what I find very interesting about the assets from Metsera are that one of them is a once monthly GLP-1, so think Wegovy, but instead of once a week, once a month. They also have a drug targeting amylin, which after the European Diabetes Conference last week is the new hottest target. And 3, they have an oral version of their GLP-1 that, unlike Novo Nordisk's oral semaglutide, doesn't have what's called the food effect, where you don't have to fast before you take it. You don't have to wait a half hour before you can have anything after. So all in, brings them up, pretty meaningfully in the race.
Yeah, and I guess also in thinking about, you talked about how that medicine is administered. We have the shot that most people are familiar with. There's been so much development around the oral route. Where does that development stand? And it sounds like, maybe I'm wrong. It sounds like Pfizer is going to probably just try to jump directly to the oral route with this acquisition, or where are we at there?
I think they're going to do everything. I think they're going to focus. They talked about their sterile injection facilities, production facilities on the call that they had earlier today. So it's pretty clear to me that injections are important, especially if they're once monthly versus once a week. I think that'd be fantastic. Combining GLP-1 plus amylin in a once monthly shot, also very competitive. And to your point, third would be a daily oral, which for many patients might be perfect.
Now, let's turn our attention to Novo and just,
Sure.
I see that as the stock story. The share price feels like that's become a broken story just on their development pipeline. And it's interesting because, most people hear GLP-1s. Ozempic is the brand they associate with it, right? You would think this is going to be positive for Novo. Where is that company in its efforts to kind of, correct the story and just get investors back on board, to where things were in, 21, 22?
Great question. And yes, Novo has been one of the leaders in this space, but they've really kind of lost their way over the past year and change, kind of missing cues from what the market wanted, whether it's DTC, whether it's higher efficacy with CagriSema. And so where they are now, they have a new CEO. A few weeks ago, he came on and is really restructuring things, cutting jobs, and that's always tough, but I really appreciate the focus. Looking ahead, by late this year, early next year, we'll have the approval of their high-dose oral semaglutide, an oral product, which would be like an oral Wegovy. We'll also have data for their drug CagriSema, which is their next-gen versus Lilly's Zepbound. What's also very interesting is they're looking at the use of semaglutide as an oral version to potentially prevent Alzheimer's disease. So they have a lot of stuff, but we need to see them refocus. And I think some investors are very, kind of tempted by the valuation disconnect between Lilly and Novo, but we're still on the sidelines as we think the fundamentals for Lilly are stronger than Novo at this point in time.
And then, Evan, quickly, I want to get you out on a question that I'm going to guess you are asked by investors, which is, okay. Talk about GLP-1s is all we talk about. What's the next, not GLP-1 medicine, but what is the next treatment for whatever condition that will be the next GLP-1s, let's say 5 or 10 years?
Oh, that is such a tough one because this is such a big market and we're so early on. Areas that I'd focus on still in metabolic disease, but looking at things like fatty liver disease, high cholesterol, and then still in inflammatory disease, there's a lot of what we call unmet need. A lot of folks that have psoriasis, that have various types of arthritis. There's still a lot of room for improvement of what we currently have, so I'm still focused there.
All right, Evan Siegerman with BMO Capital. Thanks so much for the time.
Thank you very much.
All right, well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.